Well, Walmart closing lower today, but off its lows of the session. The nation's largest retailer delivering a quarterly earnings beat and stuck by its full-year forecast. But Walmart also announcing price hikes that could start as early as next week. The reason? Tariffs. Walmart reporting they will affect some products, including toys and bananas. CFO John David Rainey telling CNBC that Walmart is trying to navigate the best that we can. Here to talk price increases, tariffs, and more, Bill Simon, former Walmart U.S. CEO. Bill is now on Darden's board and is chairman of Hanes Brands. Bill, always great to get your input, especially on Walmart. Great to see you.
Great to see you. How are you?
Good. So, 90% of Americans are customers of Walmart. Should we expect price increases? Because you say that Walmart really theoretically should be able to absorb a lot of the costs of the tariffs. Why is it announcing price increases?
Well, I think they'll probably raise prices episodically on certain items. But if you look down deep and dig into the details of their earnings release today, this quarter they grew their gross profit margin in the U.S. business 25 basis points. So they're expanding their margin. They also reported their general merchandise categories were flat-ish because they had mid-single-digit price deflation. So all that product that has the tariffs on it, they reported last quarter actually went down in price. So that sort of gives them room, in my view, to manage any tariff impact that they would have. And I think they're really, really effective at doing that.
They're the best, without question. But let's take it to 30,000. What's your view on just now the state of the consumer, given everything that Walmart just said? We've heard from a slew of different people. Going to pass on costs. They're going to try to. What do you make of all this? Because I don't think the consumer's in a particularly good spot.
Yeah, I don't think, you look at the drivers of the middle of the economy. The upper end is different, but the middle of the economy is very job employment dependent and very gas price dependent. And both of those numbers keep coming back pretty good. We're near full employment, so everybody who wants a job has one. Gas prices year on year are down. I think the consumer is fairly buoyant, and housing costs, which were a real catastrophe 24 months ago, have sort of peaked and started to head down. So I think the consumer feels pretty good on the one hand. On the other hand, all the doom and gloom we hear about price increases and tariffs, like we heard from my friends at Walmart today, I think it scares them some.
Do you think that Target is going to be particularly hurt in this sort of environment as Walmart is able to hold prices lower?
Target has the disadvantage of having a much bigger, as you well know, general merchandise, non-food business. And the non-food categories are typically very heavily import dependent. And depending on where their footprint is these days, most retailers, including Target, mitigated some of their China risk several years ago when the first round of China tariffs were put into place. But a lot of them still have exposure to places like Vietnam, and those tariffs are still, out there and pending. I think Target will have a much more difficult time mitigating and absorbing the tariff costs than say Walmart or Costco that have a much bigger food business.
So, Bill, during your tenure, you had some manufacturing initiatives with Walmart. There's obviously a higher premium buyer now, above $100,000 yearly salary for people that are shopping at Walmart. That's a big part of their revenues. What can retailers do to prevent the next pandemic, the next tariff war? What can they get ahead of here?
Manufacturing is a math equation, right? It's input costs, labor costs, transportation costs, sum it all up and get it to the customer at the best possible price. And for many, many years, because of the low labor costs and a relatively low labor costs in markets like Asia and relatively low transportation costs and oil prices, it resulted in the shifting of the manufacturing bases, as we well know. The tariff situation didn't help it. It had been discussed but never implemented at all. And that math equation is changing with an emerging middle class in Asia. The labor rates in Asia are rising as the consumerism rises. Oil prices are now at fuel prices. Transportation costs aren't as cheap as they once were. So that equation's changing, and companies have to constantly look at that equation and find out where's the best place to produce to get the product to the customer at the most efficient way. Closest to the point of consumption is the most efficient. and now it's becoming increasingly the most cost-effective.
Bill, I always play Would You Rather with you, and we're going to do it tonight again, if you will. Walmart, Target, or pick another retailer. Which is best poised to weather tariffs?
Best to weather the tariffs would be Walmart. Best, I think, from an investment standpoint. Target's so beat down. They're so beat down, and they're such a good company. They're not going anywhere. I think if you could find a way to, sort of stomach a long play on Target, you'll do really well.
Always great to have you, Bill. Thank you. Bill Simon, who likes Target.
I never thought he'd say that.
I'm glad we tag teamed on that one.
Yeah.